Sunlight lingers, mornings hum with birdsong, and evenings glow with cookouts and laughter, and the market too often drifts quietly upward. It's a month of motion, boats, bikes, and bullish momentum. So here's to finding rhythm in trading and in life. Let's begin. So why do I replace stocks with call leaps? Many traders tie up massive amounts of capital just to get stock exposure when they could control the same directional exposure for a fraction of the cost using long duration call options. Today, I'm going to walk you through my actual positions and show you how this strategy has performed in the current market. This is stock replacement, and it's completely changed how I deploy capital. So what is a leap? A leap is a long-dated option, typically 9+ months in duration. When you buy a call leap, you're essentially obtaining stock exposure with far less capital. This is capital efficiency at its core, controlling significant positions while freeing up cash for other opportunities. The key is optimizing your strike selection and expiration dates. Different delta levels give you different risk-reward profiles, and that's what determines your level of success with this strategy. When talking about buying call leaps, we need to talk about delta selection. Delta tells us how much an option price will move for every dollar move in the stock. For traditional stock replacement, I target 75 to 90 delta. That's deep in the money territory where the options price moves almost 1-for-1 with the stock. But when I think a stock will make a big move, I'll go with a lower delta. 70 to 50 delta for closer to at-the-money calls when I'm moderately bullish, and 50 to 20 delta for out-of-the-money calls when I expect explosive moves. Lower delta means higher leverage and different performance characteristics. The options won't track as closely, but your percentage gains will be much higher if you're right about direction. I have a video scheduled to be published next week that breaks down this strategy's Greek profile, so subscribe and hit the notification bell if you're interested in learning more. Let's hop into the Thinkorswim trading platform to see how some of the call leaps that I've purchased over the last few months are performing. Most of these call leaps were purchased at the money during recent market weakness that we saw in April. First, let's look at the individual equity call leaps that I hold. Let's take a look at Apple. This leap expires in 542 days. It was purchased at the money, and Apple stock hasn't been doing much, so it's down 22% for an unrealized loss of $855. Next is Amazon. 542 days left until expiration. It also was purchased at the money. It's up 61% for an unrealized gain of $2,370. And NVIDIA, we were able to go out 878 days on this one. The profit is up 26% for an unrealized gain of just over $1,100. And finally, Uber. We went with the December 26th expiration on this. It's up 78% for an unrealized gain of $1,395. So overall, the positions are doing quite well. Next, let's take a look at the core holdings in my portfolio, and that is in SPY. I'm a big fan of indexing. So the core leaps positions that I'm holding are up 159% since early April for an unrealized gain of just over $90,000. Let's take a look at all of the individual holdings that I have in SPY in the form of call leaps. And let's bring up the trades so we can see when these trades were entered. Highlighting the time frame here, you can see that these calls were purchased in early April, anywhere between March 28th and April 16th. And let's see what SPY was doing during that time frame. We can see here that there was a lot of market weakness during that time. And I became very bullish in this time frame here. When the markets were very weak, I was legging into these call leap positions. And as a result, I was purchasing at the money options as well as out of the money options. So let's highlight some of the options that I purchased that were at the money during April so that you can kind of see how those options performed after the market rebounded. And you can see here a lot of them are up over 100%. And you can see what corresponding gains look like in the P&L open column there. And these are all within the same expiration, currently having 542 days left until expiry. Now let's take a look and see what the call options did performance-wise that I purchased that were out of the money. And you can see here from a P&L perspective, they're up more than the at-the-money options, and that's because of leverage. And again, those are at the same expiration. And then finally, let's take a look at the call option that I purchased in the furthest dated expiration, Currently, that expiration has 878 days left until expiration, and that call leap is up 83% for an unrealized gain of $7,345. So that gives you an idea of what these call options can do from a performance perspective if you get direction correct. So for me, stock replacement with leaps is about opportunity cost and capital efficiency. For example, instead of using $62,000 to buy 100 shares of SPY, I can spend about $16,000 on a SPY call leap and park the rest of the cash in T-bills or use that capital for other opportunities, like selling option premium or diversifying into other investments during times of major market stress when assets are trading cheap. I still get the upside exposure, but I preserve capital and keep optionality. Let's hop into the tastytrade platform here to demonstrate a real live example of purchasing 100 shares and then comparing that to buying a call leap. If I buy 100 shares at the current market price of $627.78, we can see that would cost me $62,784. And this is a regular trading account. Margin would cost just over $30,000. Now let's compare that to purchasing a call leap. I'm going to go out to the furthest expiration cycle with 878 days left until expiration. That expires on December 17th, 2027, and I'm going to scroll down and price the 75 delta call option. And according to the tastytrade platform here, the 75 delta call option is sitting at a strike price of $515. And if I click on the ask there, we can see that it would cost me roughly $16,970 to purchase that call option. And again, that would give us a delta of 75. So a fraction of the price of what it would cost to purchase 100 shares. It's important to note that call leaps are not perfect. No strategy is perfect. Here are the key advantages and disadvantages. First, we're going to cover the advantages. Capital efficiency. You can control large positions with less money. Next is flexibility. You can free up capital for other opportunities, and there's limited downside. You can't lose more than the premium that you paid for the call option. Now let's go through the disadvantages. When you buy a call leap, you are not receiving dividends or voting rights. Next is expiration. These positions do expire while stock does not. This relates to time decay. Theta will work against you as expiration approaches, but deep in the money options do minimize this effect. And finally, liquidity. Some leaps have wide bid-ask spreads, resulting in slippage. The key is managing these trade-offs based on your strategy and market outlook. So here are my final thoughts. Stock replacement with call leaps is a great way to gain market exposure with less capital while maintaining flexibility. Now that you have seen how I approach stock replacement, I will share how I choose the right stock or ETF for these trades in future videos. Additionally, understanding stock replacement is the foundation of the poor man's covered call, which I will also cover in future videos. If you found this video helpful, please like, share, and subscribe. And as always, thanks for listening and be awesome.